Good afternoon, everyone, or good morning, depending on where you're joining from. We're really pleased that you decided to join us today. We're going to talk about strategic pricing for government contractors, and we have our guest, Robert Jones, here with us today from Left Brain Professionals. My name is Liz Brigson. I'm your host today, and it's a pleasure to be with you to help you get the most out of the presentation. Hopefully you've had a chance to join us before. This is the 10th webinar in Robert's series this year, and it's been just a wonderful series. So if you've joined us before, you know all of this. If you're new, welcome. We'd be happy to catch you up, and we do have some self-study options available. So first of all, we'd love for you to utilize the GoToWebinar questions pane for live interaction. So if you want to pop out there and say hello and let us know where you're joining from, I'd love to give you a warm welcome in the questions box. We have the handouts for the presentation available for you. You can download them from either the GoToWebinar control panel or from your Incoursa dashboard. Today's webinar is an hour and a half, so we will launch 7 polls. We'd love your responses to all 7 of the polls. In order to earn CPE credit, you'll want to respond to a minimum of 5 of those poll questions. If you qualify for CPE credit, you can download your certificate from your Incoursa dashboard, and that is always available for you an hour after the program concludes. And if you have any questions, you can always email us at support@incoursa.com. All right, well, Robert has put together a fantastic presentation for you today. I really enjoyed flipping through the slides in advance of the presentation and just seeing what we're going to cover today. Robert has a master's in accountancy from the College of Charleston. He has been in business management, compliance, operations. He's held roles as a controller, a defense contracts manager. He is the government contracts and accounting expert and founder of Left Brain Professionals, where he really has just invested so much in the governmental accounting community and with governmental contractors as an instructor and a speaker. So Robert, it's great to have you with us today. Thank you so much, and I'll turn things over to you.
Yeah, well, thank you. It's always a pleasure to be back here on the Incoursa platform. And as Liz said, this is number 10 in our 12-part series. She said you can go back and pick up some of the others. A couple of more coming up this year, and we've already started planning out our 2021 series, which is another 12-part series, and you'll see some information on those coming to your email inbox soon. Today we're here to talk about strategic pricing. Just a quick blurb about us at Left Brain Professionals. We are a boutique accounting firm in that we serve only government contractors, and we practice primarily accounting system design, implementation, audit support. We do some cybersecurity compliance and training as well. Some of the common tasks that we get involved with our clients include the SF 1408 survey. That's the survey you go through to achieve the adequate or an approved accounting system. A lot of work with indirect rates, bids and proposals, cost and price analysis, and obviously you can kind of see how that ties into our conversation today around strategic pricing. A couple of my other colleagues here, Melissa and Steve. If you interact with us or connect with us, it's very likely you'll have an opportunity to chat with them. And for today, our learning objectives, and I always say if I do my job well, and I should say that if you do your job well and pay attention throughout the next 90 minutes or so, you should be able to describe market-based or top-down pricing, list the components of a cost-based or a bottom-up approach to pricing, describe the hybrid approach to pricing, and list some alternate pricing strategies. Before we get into the content, we do have a polling question, kind of gauge where everybody is as we start today. So Liz, if you'll kick that off, please.
All right, always great just to get a room check on how people are feeling confident in pricing strategies. So we'd love to hear from you. Perhaps you are an expert on pricing strategies, or maybe you don't have a pricing strategy yet. So we'd love to find where you fall on the spectrum as far as your confidence level in your pricing strategies. So we'll leave this open for just about 5 more seconds here. Robert, looks like we're getting responses coming in quite quickly. So thank you, everyone. All right, very good. I'm going to go ahead and close the poll down, and let's take a quick look at those results. So it looks like we're hearing just under half the audience doesn't have a pricing strategy. And if that's you, if you want to go ahead and just let us know why that is or what your goals are around perhaps developing a pricing strategy, we'd love to hear that. And it looks like we also have a third of our audience with some metrics but nothing concrete. And then about 15% of you pretty confident and 2% experts. So really looking forward to your participation in the event today.
All right, so let's dive into the meat of our topic. And in the government contracting space, and I assume that, well, and I should say really everything that we're going to talk about today, even though we're focused on government contractors, this series is focused on government contract accounting. Many of the subtopics that we've discussed this year certainly apply across the board to commercial contractors, commercial entities as well. And certainly what we're going to talk about here today, there's really nothing that's unique to government contractors. Other than some of the, obviously when we start talking about cost type contracts, we typically don't see much of that in the commercial space. But this pricing to win terminology is something that comes up. And again, we see this and hear this in different places. And so what I want to talk about here is really setting expectation. There are some consultants out there who say, we're gonna help you on that price to win, and they almost sell it as if you use their services, you're almost guaranteed to win the proposal. You're guaranteed to win that award, and so just be very careful is kind of my caution there on that. In this pricing to win approach, as we've got here on the slide for you, clients come to expect a certain rate or price based upon an initial contract. Which means that raising your price later becomes more difficult, right? So if pricing to win, basically what I'm saying here in number one is, from a pricing to win perspective, sometimes you go in at the lowest price. And I'm not saying that that's a bad decision. There are certainly times and reasons why we focus on lowest price. It depends on the industry and the commodity. It depends on, if this is a sealed bid, if they're expected to be negotiations, if it truly is a lowest price award type of approach versus a best value, right? So where, again, in the case of the government, that sometimes, they'll do what we refer to as the LPTA, which is lowest price technically acceptable, or are they going to do a best value where they're not necessarily going for the lowest price, they're looking at the overall best value, right? Which means I might be willing to pay a little bit more for that product or service, knowing that I'm getting something extra out of it. So be careful with this. If your price to win strategy is go in and say, well, we're just going to do the lowest price to get our foot in the door. And that's a phrase I've heard too many times. We're going to bid the lowest price, or we're going to bid a price, I should say, because you don't necessarily know if you are the lowest, but you're going to go in at a lower price and you're going to bid that with the assumption that we're going to get our foot in the door. Okay, well, part of what becomes problematic here as we go into number two on the slide is, and really, let me connect number one and number two. If you go in at the lowest price, your customers begin to expect that price, right? And so if you win this contract and you expect that you're going to get follow-on work, right? This concept, I get my foot in the door, then I'll do additional work. It becomes more difficult, right, to do any significant price raises later on, and certainly maybe even modest price raises if it's an immediate follow-on contract, right? Because what's going to be your client's first response? Oh, that was $100 a unit on this first contract, and now you want $125 a unit, and you can't really go in and say, well, I lost a bunch of money on the first contract because I bid it low. Well, that's not your client's problem and responsibility, right? So we have to be careful about that. If you get your foot in the door with this lowest price, then number two, what can be the problem is you may not have the cash flow to do the work in a timely and an accurate manner, right? So you can end up in a situation where, and we've seen this unfortunately, where contractors have bid something at or below cost, and they can't generate enough cash flow to then actually cover all of those costs, right? So then we get to a certain point in the contract where now I can't do any more work because I don't have any cash, right? And so then what happens is that last part of number two, that you run into a situation where your contract could be canceled, right, for failure to do the work, right? So you could have a termination for cause. And you can end up, right, you don't want a termination for cause on your record, and you don't want any negative performance ratings, right? You don't want to do something bad and then that be on your record. The third thing that could be a problem is if your proposal is going to be evaluated for cost reasonableness. Now, the government is supposed to notify you in the RFP that they are going to perform cost reasonableness evaluation on the proposal. And simply what cost reasonableness means is the government is going to say, okay, we put out this scope of work. We've got this group of proposals that we've received. And we've got one that, right, the price is really enticing, or maybe we've got a couple that the price is really enticing. We've got one that the price is really enticing. We'd like to do it, but it's almost like the price is too low, right? So then what comes into the mind of the contracting officer or your prime, whatever the relationship might be, then the conversation kind of going through their mind is, either one, they didn't understand the scope of the project, right? So you run the risk that maybe they didn't price everything included. They missed something as an example. Or they maybe, even if they did, they priced it in such a way that you're back to this number 2 situation of above, where they've priced it at or below cost, trying to win the work. And then you, right, if you're the government, if you're the prime, and you award that, and you're looking at it saying, well, that was a really low price, and I'm not, we've even heard, like, how in the world can they even do the work at that price, right? So if that's the kind of question that's going through your client's mind, then that can obviously be problematic for you. And bidding, we had a little slide issue there. Bidding at a loss simply to win the work is just not a viable strategy, right? That's what all of this is about here. With that, Liz, another quick polling question, please.
This is a really good recap. Raising your price at a later date is simple. True or false? Probably any of us who have had an opportunity to set prices can definitely tell which answer is correct. And it looks like most of the audience is clicking in on one particular answer choice. So let's 5 more seconds. Yeah, go ahead, Robert.
No, I was just going to say, if I don't give away for those who haven't answered yet, but even in our business, right, pricing as an accounting firm is a tricky situation at times, right? We have to look at, and actually we were just making some updates, looking at some financial projections for the next 12 months, looking at where we've been, did we hit our target rates? Do we need to adjust any of those rates, right? But clients are sensitive, whether you're going to go up or down, right? And rarely do we go down in price, but anytime you're going to make an adjustment, right, clients are sensitive to those adjustments. And so we have to be careful, at the very least, about the timing of those adjustments.
Definitely. Well, we'll go ahead and close the poll down, and 93% say false. So that would be the correct answer.
That would be the correct answer, yes. And again, even for what I just said for us as a firm, right, that we win a client, right, and I'll tell you that we don't price, I tell potential clients when they come to us, we're not the cheapest, we're not the most expensive, and I can tell over the years we've had a few clients try to haggle us on price, but what I will find is that the best clients turn out to be the ones who never ask what our price is. I can tell you we've had a fair number of clients who sign up. They sign up with us based upon feedback from other clients or others in the industry that hire us, and we've had people, they've never questioned us, or they've just said, what is your rate? We tell them the rate, and they're like, okay, right, because they know what they're buying, and they're happy to pay a fair price for good service. All right, let's talk about these concepts here now. Again, the first one is going to be the top-down approach to pricing, and then we're going to look at that bottom-up and a hybrid approach. So what is the market-based or the top-down? you got to know your industry. So when I talk about market research, and I gave an abbreviated version of this presentation the other day at a conference that I'm actually at right now in San Diego, and and somebody said, how do you get this information? And it's easy for me to say market research, and I realize that depending again on your industry, on your commodity that you serve, that you sell, it can be difficult to obtain some of this kind of information. The first part that we'll talk about with contract types and some stuff should be pretty clear and easy. I'll admit that, getting pricing information from our competitors is very difficult. It can be difficult for us in the accounting industry. Now, and maybe some of you are having this question in your head right now before I even get to some of this content. You got to poke around. You got to network with people. You got to go to conferences. You got to have, and I hate to say it, but sometimes you got to have cocktails with somebody, and you get somebody to chat a little bit. And I'm not saying that you're doing anything illegal or anything like that, but you just start having conversations with people, and you begin to piece together information. We've actually had clients share with us what they've paid our competitors to do the same or similar work. That's one, and quite frankly, we came in less than some of our competitors at times. Again, not that we were trying to be, it was our list price. We just happened to be less than somebody else. Some of those firms, I kind of know what the difference in price is because I know there are some big name firms out there, right? And quite often, I mean, the reality is you oftentimes are paying for the name. You're paying for the big name they have. You're paying for all the marketing and advertising that they do. You're paying for the fact that they have, a lot of real estate. I mean, they own buildings, they lease buildings, right? They got Class A office space in a 50-story building downtown somewhere, right? That stuff doesn't come cheap. So, you might get the same level. Hopefully, you're getting the same level and quality of service from us, hopefully even better than what you're getting from them. The difference that you're paying in that price, right, is because of their location and of their name. So that's, some of those things we have to consider into our factors to say, if you're a small business out there and you run a lean operation, we work remotely. We don't have any rented or owned office space anywhere. We've been remote from the beginning, which has been nice in this whole COVID transition stuff. So that aspect of COVID didn't really affect us at all. But you can kind of take that information and say, okay, if I'm comparing Robert's firm to one of the big name firms that I know has a big office somewhere, right? You can probably expect that my rate is going to be a little bit lower than somebody else's just by knowing a little bit about my business. Back to this concept of the industry, though, and again, the product and service that you sell is, what are the typical contract types out there? And how does that contract type factor into the pricing perspective? Right, so a fixed price contract, pretty simple, straightforward, right? There's a set price for the totality of that work. And how that's paid and financed is a little bit different. So you might have a fixed price contract where you get to invoice for each delivery in the case of a product. It can be something where, again, depending on the terms of the contract, it's a fixed price that you get to invoice all of it at the end. Regardless, the scenario is, right, that it is a fixed price. And that's got to be a factor that you have to think about in pricing this, in pricing your proposal, right? Because you're taking the risk of delivering, meeting all of the requirements, delivery and otherwise, right? You're going to get it there on time, and you're going to deliver exactly what the customer wants without any issues. And, and you're taking the risk of doing that at a fixed price, right? So what typically happens? We have to build some kind of buffer in our price, right, to let us know, okay, what if something goes wrong? How do we handle that, right? Because you don't want to necessarily be the lowest price at that point. You still certainly want to have a competitive price, but going in at the lowest price in that type of environment might not leave you any margin for any kind of errors or issues along the way. Then we have T&M contracts. This is a time and material. The scenario that I always give people is think about the plumber, think about the electrician. Most of us take that concept pretty easily. Right, because let's say, and actually one of my colleagues owns a building and he got a call from one of his tenants that there's water running down the wall. That's never the phone call, right, any of us ever wants, right, that there's water running down the wall, what's going on, right, so he's got to get a plumber out there. So we know part of the problem, right, there's water running down the wall. What we don't know is, right, where is it coming from? How much, how long has it been running down the wall? Where all did it run, right? What kind of damage is involved? And so that's where a T&M contract kind of makes sense, right? You get the plumber in there. Obviously, the first thing you're going to do is find the leak, stop it, right? Get that repaired. And then we've got to go and figure out where all this other damage is. And we're going to pay for the time for them to do that plus the materials, right? And that time, the time portion of that is at a fixed rate, right? Because the plumber says, hey, my rate is whatever. I took my motorcycle to the garage the other day, to the shop. I found a little bit of oil on my garage floor a couple of weeks ago. Turns out I had a faulty seal. I tried to take it in. Luckily, the part was $2.04. Only took them about a half an hour. Right, but when I take it in, my question was, hey, what's your hourly rate? $115 an hour. So I can know, okay, well, how many hours is it going to take you to do this, right? So I get a sense in my head of what's going to be involved. That's a T&M type of contract. A cost type contract. As I said earlier, this is fairly unique to the government. We do see some cost type contracts at times in the commercial space, but really we see a lot of this in the government space. Right, this is where I put together a proposal of what my costs are. I bill the government for those costs, and then depending on how the fee is structured, whether it's an award, a fixed fee, an award fee, or an incentive fee, as to how I make my money on it. But I'm getting reimbursed for my cost. And there's some interim billing rates and some other factors that play in there, and we won't get into that here today. The other thing I need to know about my industry is how is this typically priced, right? Is it sold? Is my service sold in hours? Am I selling widgets, right? Am I selling a product? Do we typically price this in phases, as an example? One of the questions that we often get, and I'm sure my other accounting firms that are on the call today, right? Do you do any fixed price work? And to date, our answer is no. And the reason for that is, as many of you know, right? We talk about peeling back the layers of the onion. It's very difficult in the type of work that we do, especially the consultative type of work that we do, to be able to go in and upfront really know the extent of the problem. Just like when you call the plumber, right? When people call us, they kind of tell us what the problem is. When we look at financial statements and ask some other questions, we can kind of get a sense of where the problems are. We kind of know what our strategy is, what we're going to tackle, how we're going to tackle it, because we've had enough experience doing this, right? Just like the plumber, right? They kind of know what they're going to get into. But until you get in there, right, and the plumber starts ripping out the wall and really finding out, what's going on, the same is true for us, right? How it's difficult. A plumber is not going to give you a fixed price on that, right? Because he doesn't know how the problem is, how bad the problem is. And the same thing is true for us. Then you got to know your competitors, right? Here's another aspect of the industry. You really, really got to know your competitors. And when I say you got to know them, you got to know them. You got to know who they are. You got to know who the players are. You got to know, who are the principals in those organizations. How do they operate? Where do they operate? Who are some of their customers? What do other people out there in the industry know about them? What kind of feedback are you getting? I can tell you that, some of that information we get from clients, right? Because we get people who come to us, they're leaving another firm. And I'm always very professional and very respectful about it, but I will often probe, and I don't get too deep into it, but I try to ask, what did you like or dislike about a previous firm? Sometimes I don't even have to ask, right? Sometimes somebody calls me up and says, I'm so tired of this crazy other person, they're late, they don't respond to my emails, whatever, and I sometimes get an earful of why somebody is leaving another firm, right? That's a piece of information that's helpful, right? Because then as I run into other people, as I run into other potential clients, and I find out who they're working with, there aren't many, at least in our industry, who do what we do. And I can't say that I know absolutely everybody out there, but I know a fair number of people out there who do what we do, right? There's some big firms, there's some smaller firms, there's some one-off individuals that do work, and I kind of know who they are, and and I've heard who's good and who's bad, right? And some of that you get, again, by talking to people, going to conferences, talking to clients, you'll get that feedback. Part of what you need to know about your competitors is how are you different? What are you doing that your competitors don't do? I hope I don't offend too many on the call here from my fellow CPAs out there, but how many of you are still doing a lot of work with paper and pencil? That's one of the struggle. That's one of the things that we hear oftentimes from our clients who come to us One, they're typically, obviously, they're coming to us for the government contract compliance aspect of their accounting, but they've often been dealing with a local tax CPA for a number of years, and they'll say, this guy or this gal, whenever time I go by their office, they're still over there with a pencil and paper and green bar paper, and it blows my mind, right? We're in 2020 and we still have people out there, right? So that's one thing that sets us apart. We're a completely virtual firm. That we work remotely, we work with the cloud, we help the clients with their data, we make their data available to them 24/7 wherever they are, right? We offer a different experience than some other firms do. And so, again, by knowing who my competitors are, I know how I'm different, and then that makes it an easy sell for me when I'm talking to somebody. And I don't have to talk negative about a specific name or a specific firm. I don't even have to say, oh, compared to this person or that person, I don't even have to say that. I just say, this is how we operate, because I know that's the positive feedback that we've had from other clients, and I know that's something that resonates, when they're looking at changing firms. You need to know, is your competitor focused on lowest price or best value? Again, that concept of, are they just trying to be the cheapest person in the industry, hoping they get the work? Or are they really focused on delivering a quality product and service, right? That best value approach, not necessarily the cheapest, but they're really focused on delivering the overall best value. And in the world of products, that can also be, that best value can also include this total cost of ownership approach, right? So it might be, I think about printers as an example, and especially inkjet printers, right? If you guys are not aware, HP and Canon and Brother and Lexmark and some others that are out there, they do not make money selling printers. If you guys don't know that, read up on it. They don't make money selling printers, right? What do they make money on? They make money selling the toner and the ink that goes in them. That's where the revenue is for them, right? Because they know I can get you on a $99 or even a $399 printer, and you might think, wow, $399, they're not making any money. Might make a little bit or something, but that's not where their business is. Their business is, I'm going to get you on the toner and the other stuff later, right? Because you got to keep coming back, right? So that comes back again to that best value, total cost of ownership approach. You got to know the current market conditions, right? And we could have a whole separate conversation about today's current market condition, right? And the market conditions include the economy, they include politics, they include the environment. And again, always depending on the nature of the product or service that you sell, who you're selling to, right, who your market is, any of those factors can be at play, and some of those factors can be more important for your industry. As an example, for government contractors as a whole, and we can talk about whether we agree or disagree with this, but as a whole, government contractors tend to get a little uneasy around the change or potential change, right, of an administration. And that's where we are right now with the election coming up on November 3rd. Doesn't matter what side of the aisle you're on and who you plan to vote for. It's not about that. It's about the reality that there is the possibility of a change in administration, okay? So that brings a certain uneasiness into, government contractors, because as administration changes, what happens and why are government contractors concerned? Those budgets change, the spending focus change. Even if the government spends the same total dollars, they may spend it in other areas. Depending on the administration, right, they may increase or decrease spending. And those are all factors that can affect government contractors as an example. But what about the surplus or shortage of goods and services? Back in, and I don't know if there really was a surplus, but, back in January, for example, there might have been a surplus of PPE or certain parts of PPE. I don't know if that's really true, but it's certainly feasible, or certainly plausible, I should say, right? That there might have been a surplus of some of those items. Well, for many weeks, you couldn't get your hands on anything, right? You couldn't buy sanitizer. You couldn't buy gloves and masks at the local store because they had all been gobbled up everywhere. Now most of that has shifted, right? I think finally now, maybe it's been about 3-4 weeks ago, I was actually able to go to my local Target and buy wipes, right, to be able to wipe down the counters and stuff. I mean, we had been buying spray, and we had cloth and paper towel and stuff at home, but actually having the wipes, right, nobody can get their hands on. And there's certainly not a surplus of it at any of the local Targets that I've been to, but that stuff is coming back into play. Overall economic trends, right? So one of the things that's happening with the economy right now, and I just had somebody ask me the other day, he said, hey, as a CPA, what's your opinion on the economy? And I'll spare you guys, my lengthy answer to him, but, we do have to look at, right, what is happening in the economy. And at the very least, we know there's still a lot of unknowns in the current economic environment. It's kind of interesting that we have a portion of the economy that certainly has been decimated. We know hundreds of thousands of businesses have closed their doors, many of them permanently. They'll never return, or certainly not anytime in the near future. We also know there are other businesses that have continued to survive. Many, or I should say, at least some are thriving, right, and have taken off because, again, they're selling PPE or they're doing something else. Housing prices are up, but certain parts of the economy are still suppressed, right? So there's a little interesting factor at play there. You got to know how that's going to affect who you're selling to and what you're selling. With that, Liz, another quick polling question, please, and always gives me an opportunity for a quick drink of water.
Yeah, definitely. So let's get this third poll launched. And the question is, let's make sure that's launched. There we go. The question is, which is not a component of market-based pricing? Know the industry, price to win, know your competitors, and know current market conditions. I think it's so interesting too. Each of these points, there's so much to unpack, but specifically as you talked about knowing competitors, and you just definitely underscored how important that is to know competitors. And sometimes as a business leader myself, I like to think like, if we can deliver a great experience and the best product, then we can win without having to get into all the details of what competitors are offering. But listening to you is really providing a bit of a call to action to, scan the surrounding environment a bit more frequently, just to know what's going on out there to make sure that we're staying current.
And what you just said is also something that I responded to that question in the other seminar that I gave the other day. Was, this market research is not a once and done, right? So you can't say, okay, I'm going to sit down on Saturday and I'm going to see what's out there and what's happening, and I'm going to write a little notebook or whatever. And that's great. I'm glad you're doing it, but it's something you have to stay on top of. And I'm not saying that has to be a weekly event, but probably monthly, quarterly, right? You got to do a fair amount. Did somebody else enter the market? Did somebody leave the market? Did somebody retire? Did somebody die? Did they sell their business? Did they change their business model? Did they acquire somebody else, right? There's so many things that can happen over time that you've got to stay on top of those.
And you really gave a great example in your own business, how you very carefully and respectfully are able to kind of learn some of that from your current customers as well, which I think is just, that's very beneficial to everyone who's in the audience, just to have a path to approach those topics. So from a poll result perspective, 89% of you responded correctly. Price to win. I think we heard quite a few reasons why price to win might not always be the right long-term winning solution.
Yep. All right. So back to our content here. So we just covered, again, the market-based top-down approach. Now we're going to talk about a cost-based bottom-up pricing. And one of the things that came to mind just while we were chatting there, Liz, was that somebody might be sitting out there and saying, well, how does all of this apply to accounting, right? If I'm an accountant, why am I on here talking about pricing? Isn't that somebody in business development or marketing? Well, certainly they have a role in it, right? But we as accountants also have a big role in this, right? We can be helping with market research potentially, but we can certainly, we can help from the numbers perspective. And this part here, this cost-based bottom-up pricing, is definitely an area where we can help from our expertise. And the question that we're asking here that we need to get an answer to is, how much does it cost me? How much does it cost me to deliver this product or service? And when we talk about cost, You'll see some familiar terms come up from some of our previous webinars. We talk about direct costs. There are some key cost elements out there: labor, material, travel, ODCs, and subcontractors, right? So all of those things, right, if I'm going to deliver a product or a service, now if I'm delivering a service, I may not have much in the way of material unless I'm doing some T&M kind of work, right, where I'm potentially reselling some pass-through kind of materials. But, all of us, regardless of what we're selling, typically have all of these. And, when we talk about labor, right, labor, as I've said many times before, is one of the, if not usually the most expensive thing that a business has, right? It's paying our employees. Those were our direct costs, but we also have our indirect costs, okay? Our indirect costs, as we've talked about before, are fringe, overhead, and G&A. Quick reminder here for you: fringe are those expenses that we incur to maintain our employees, right? So it's not only what is the direct labor cost, right? So somebody makes $25 an hour or $30 an hour, but I have to apply the fringe, right? So that's my employer taxes, that's the paid time off, retirement, health insurance, stuff like that. Then I have my overhead. Overhead are those expenses that we say support all of my clients or all projects, that I cannot easily identify those expenses to a single project. Some examples in there: we usually have our facility cost in there, supervisors are in there. Like the supervisors are usually, right, they're managing multiple people, managing multiple projects, right? Those kinds of things go into overhead. And then G&A are those costs to run the business, right? So I've got to have accounting, HR, IT, business development. We got, taxes and licenses and other things that I need in order to operate my business. And a quick little scenario that comes to mind here, a little story that I like to tell. So my mom, before she retired, worked for a number of years for a couple of different motorcycle and ATV shops, right? So they sold and repaired motorcycles, ATVs, that kind of stuff, tractors, lawnmowers, and stuff as well. And she worked for this one company for, I don't remember now, 3 or 4 years, something like that. And she would call me, because I've lived away from there for almost all of my adult life. And she would call me, and we'd be chatting, and she's like, Robert, I don't understand it. She's like, I know how much it cost us to buy this stuff. She did some bookkeeping and some sales, kind of had a couple of different roles in the organization. And she's like, I know how much it cost us to buy, this motorcycle as an example. And, and then somebody comes in, and if the owner happened to be there and he was the one servicing that client, she's like, he was always eager to negotiate the price, right? So let's say as an example, something had a list price of $5,000. Right? So that's the tag they've got on that motorcycle or that lawnmower or whatever it is. They're in the shop, right? So they got a sticker price on it of $5,000. And my mom is saying, yeah, I know that, and there's some more behind the scenes of how all this stuff works, but, she would say, I know that cost us about $4,200. That was the invoice to us as a dealer was going to be $4,200. So if we sold that, obviously at $5,000, that meant we had $800, right, to apply to all these other costs that we had. And there are some incentives and some other things that come into play, and I'll leave that out at the moment. But she said the owner, and there could be a number of factors, right? He wanted to make a sale that day. It might have been somebody who he knew. He might have just been feeling desperate, like it's the end of the month, and I want to get one more sale in so we can try to hit these quotas where they would make additional incentives, or some other factors that might come in as to say why he'd be willing to do more negotiating with one client coming in the store than somebody else. Maybe it'd been quiet all week. Maybe they hadn't seen very much traffic, and the fact that we actually had somebody in the store, and many of us have been there. Again, it doesn't matter what the product or service is that you sell, right? If you go for a period of time and the phone hasn't been ringing and you're not selling stuff, and then all of a sudden somebody calls and says, hey, I'd like to hire you, or I'd like to buy this, and you say the price, and they go, well, again, we've all been guilty at this at one time or another of saying, whoa, I'll knock $100 off, or I'll knock $200 off. And so he did this on a regular basis, and my mom kept saying, I kept trying, and this is her saying, she said, I kept trying to explain to him when he was constantly negotiating these prices, he was cutting into our ability to pay all the other bills. And the only concept that he has, well, I know it cost me $4,200. Yes, it had a sticker price of $5,000, but I sold it at $4,700, so we still made $500. In his mind, at the end of the month, there should have been $500 left from that sale for him to put into his pocket as the owner, as profit. He didn't understand this concept that he had all of these other expenses that he still had to pay. And a little bit of a long-winded story there, but it ends this way. So 3 or 4 years into this gig, my mom was at work one day, everybody says goodbye, whatever, normal end of the day, they go home, she gets up the next morning, drives to work, and lo and behold, can you guess what happened? The doors are locked. And in fact, they're chained shut because the owner went out of business, didn't tell anybody, knew obviously the night before, right, that he was going to do this. And they went out of business because they didn't have any money. They couldn't pay employees. They couldn't pay their expenses. They couldn't pay their rent because of these things of not understanding how much something cost them. So it didn't matter that he was selling it for more than what they cost. He didn't understand the total full cost of that product or service. And that's one of the things that we work really hard to make sure that people understand. And I think that that's one of our key roles as accountants in an organization, right? So again, there are parts of this pricing that we're going to have marketing and business development and other executives involved, from a strategic perspective of, what do we want to price and what does the market bear and some stuff like that. But there's also this aspect of we need to understand what our cost is, right? Because at the end of the day, if we're not covering our cost, it doesn't matter what we're selling it for. If we can't cover our costs, we're never going to make any money. And we're all in business to make money, right? So that's what we got to keep, we got to stay ahead of. It's also important to note here, just as a quick reminder, that when we build up our rates, right, when we do those budgets, when we calculate our rates, those rates are built on a set amount of direct costs, right? Because direct costs go into the base of each fringe, overhead, and G&A. There's an inverse relationship between direct and indirect costs. And if we have any significant variances, either indirect or indirect, let me try to say that again, get that confusing. If I have any variances in either my direct costs or my indirect costs, those rates can be out of whack, right? Because we've got an inverse relationship between direct and indirect. And so if the pool or the base gets bigger or smaller or both happen at the same time, like some weird things can start happening, and we have to stay on top of and understand those rates. With that, right, what are some things that affect indirect rates? Well, an increase in direct costs results in a decrease of indirect costs. So let me say this again. Let me pause, right? And I always love to use my hands. Right, so when we're talking about rates, we have a pool, and then we divide by the base, right? So pretty simple, straightforward math. If the pool gets bigger and the base stays the same, then what happens, right? My rate goes up because my numerator is now bigger than my denominator. So if my numerator gets bigger, then my rate's going to go up. If my denominator gets bigger, then my rate's going to go down. And then sometimes we have situations, especially when we look at a shift of dollars between or among pools, right? So if I have a shift of dollars between direct and overhead, as an example, we can even have a compounding effect where, and we've seen we always see this during any type of pandemic or situation where we don't fire employees when we have a downturn in business, because we don't want to lose that, we don't want to lose that knowledge base and that skill set. So we take a chunk of direct labor, we move that into overhead labor, right? Because we keep them. I can't charge them as direct because they're not doing client work. And so when I calculate my overhead rate, I've had this compounded effect where my overhead pool has gotten bigger because I put labor in there. But at the same time, my base that is primarily direct labor has gotten smaller. So now I've got a compounded effect where that rate really goes up. So we have to understand this relationship between direct and indirect costs, and specifically between and among the various pools. Again, a quick reminder here, if I have an increase in direct costs as a whole without any corresponding increase in indirect costs, then my indirect rates as a whole will typically come down. Well, then the reverse is going to be true, right? So if I have a decrease in direct costs, meaning I've lost work, and many of our indirect expenses can be fairly fixed, especially when we talk about G&A, right? And even a significant portion of overhead, right? If you've got rent or you own a building, those costs stay steady regardless of the amount of work that you do, right? So if you're down work for a month or a few months, we typically can't shed those kinds of costs, so we continue to pay them, and that again continues to have this effect on our rates. Winning or losing a big contract can affect your indirect rates and your pricing structure. I've probably used this scenario on some of the previous webinars, but I talk about, and we've just seen it so many times, which is why it's easier for me to use, small businesses who have doubled, tripled, even quadrupled their businesses almost overnight by winning one government contract. And what typically happens is you'll have a small business, they're new to government contracting, they win a couple of these small contracts, maybe $100,000, a couple $100,000 here. They do a couple of those, they get their feet wet, they do a good job, right? They deliver on time, at or under budget, whatever, they've got good rapport. And then all of a sudden, a big opportunity comes and they say, hey, we're going to bid on this. We're going to bid on that $3 million contract. Or we're going to bid on that $5 million contract. And they win it. And again, all of a sudden they see their business explode overnight in a good way, right? They won all of this. Well, there's a fair amount of that work that they can absorb without incurring any additional costs, right? They might be able to do a lot of that work without a new building, potentially, right? They may or may not spend any more money on human resources and HR and business development and some other stuff, right? A lot of those costs might be fixed. So you can see now, if I have a huge increase in my direct expenses, this has a big impact on my rate. Not a bad thing, but it means I need to update my rates and my pricing structure accordingly. What I just said here, winning that large contract increases your direct rates, which would typically decrease your indirect rates, assuming that you did not, bring on any additional indirect costs. And for what I said, right, to many of us, we have a certain amount of additional bandwidth within our organizations that we can absorb work without spending any more money. One of the issues that you might run into, we talked about this early, I think this might have been number 4 in this series, if I remember correctly, where we talked about multiple or advanced indirect rate structures. We talked about the situation where you outgrow that single indirect rate structure, right? Many small businesses, pretty much most small businesses, the first time they calculate indirect rates, they've got one fringe, one overhead, one G&A. So we say they have a single or one indirect rate structure. And then what happens, and if you missed this webinar, go back, watch it, catch up on it. But we talk about, okay, what if you're in a situation where you've got multiple product lines or multiple divisions, multiple operating locations? There are a number of factors that come into play and what drive the cost of an organization where you say, this single rate approach really isn't making any sense. My favorite example, and this is one that applies in a lot, is where you'll have a company that does both engineering and manufacturing, right? And the cost drivers of those two divisions in a company are very different, right? Manufacturing tends to be very expensive. We've got a lot of heavy equipment, usually, we've got warehouses, and we've got inventory, and we've got other things that drive up the manufacturing side of our business, whereas the engineering or services side of the businesses tends to be very lean, right? Especially if it's just engineering. We oftentimes have, several engineers, relatively small space, some computers, printers, maybe some extra, network equipment that they need. but the cost of running that is significantly different than the cost of manufacturing. And so I look at saying, okay, if I want to be more competitive, right, and better align these costs with these products or services that I offer, then I need to split from this single approach and go to 2, 3, 4, whatever is appropriate for indirect rate structures. And we see this again for companies that are growing and become more complex. They add new product lines, they acquire a company, they add operating locations. What we've seen from the manufacturing engineering sometimes is that a company will typically have thought of themselves as a manufacturing company because they manufactured product. They always had engineers because they had to have engineers to help design the product and to do things for manufacturability. But maybe they never thought about, or they just never took the approach of selling the actual engineering services separately. And then they realized, hey, we can actually just sell the engineering side of this stuff too. But applying a manufacturing indirect rate to engineers puts you in a situation where now your engineering rate is not competitive with others in the marketplace, right? So this is that time where, okay, now we need to look at this and figure out how do we become more competitive by altering our pricing strategy. With that, Liz, another polling question, please.
All right. So the question here is, which is a true statement about indirect rates? That poll's live. And Robert, I think you gave a really great example just talking about the kind of the off-road vehicle, motorcycle type example where your mom was, firsthand impacted by someone's inability to really differentiate between the difference of direct costs and indirect costs. Do you find sometimes, though, that when you're thinking about things that are maybe not quite as concrete as a motorcycle, for instance, that sometimes even accountants might get just find a little bit of ambiguity in the difference between direct cost and indirect rates?
I'm going to pick apart your question a little bit. So I don't find the problem so much with accountants. when you include them in there, I think the accountants typically have a good grasp of that. Now, they might get confused about whether something is overhead versus G&A, whether something should be a direct cost or should be an indirect cost.
Right.
But I find that most accountants, right, have good. It's where we've run into it are business development people, owners, those who don't have a good concept of all of accounting, right, and thinking about the fact that, and it's not that they're dumb people. I'm not saying that they're dumb or ignorant or anything like that. They just don't have this clear concept. And I can give you another quick example. I ran into this early in my career for a gentleman. I was brought on board as a controller for a small company, and the owner, when he brought me on board, said, "Look," he's like, "we're selling a lot of stuff. There's cash in, there's cash out. Like there's a lot of activity. We're busy, but there's not much money left at the end of the month." And he's like, "And I just don't know why. I don't know what's going on, and I can't figure it out." And what I figured out was it was kind of a similar situation, a completely different product line. But it was a similar kind of thing where he had a general manager, a kind of a general sales manager, whose concept was, oh, this item cost me, $300 as an example. Yeah, we're supposed to sell it at $400, but if I can sell it at $350, knowing that I'm going to get these other bonuses. So in a lot of retail sales kind of stuff, and some of you may know this, right? You get spiffs. So what they're basically bonuses that go to the retail company. Hey, if you sell 50 motorcycles this month, not only, you still have to pay us the regular price, right, for each of the motorcycles. But if you sell 50 this month, we'll give you an extra, and it's usually a per item thing, right? So they might say, we'll give you an extra $100 or $200 or whatever it is per each of those. Oftentimes they're tied to certain models, right? The same concept of cars. If you wonder why, when you go to a retail establishment and somebody tries to point you to a particular item or a particular brand, it's usually because there's a behind the scenes spiff on it. And the more they sell of that model or that brand means that they get it. But here's the trick. In the case of, again, they'll say a certain number. You got to sell 50 motorcycles in order to get it. If you sell 49, you get nothing. It's not like you get 49 times the spiff. No, you don't get this. You get the spiff on all 50, but you only get the spiff if you sell at least 50. And so, and actually, this was part of the problem that my mom's employer ran into, and that I ran into with this other gentleman early in my career. He was banking in the back of his brain. He's like, well, if we sell 50 of these a month, I know we get an extra $50, right, for each one. So even though it's supposed to be sold at $400, I'm going to sell them at $350 because I know I'm really going to get $400 because I'll get the bonus at the end of the month. Well, what I found out is that they never hit the bonus. They never sold enough to actually get to the bonus amount. And that's why they were losing so much money.
So it sounds like a lot of education behind the scenes, like for the business team generally. And I'm going to go ahead and close this poll question down because it looks like about 70% of the audience got the right answer about that relationship between indirect and direct rates.
Yep. Yeah, I think that is correct. That's good. This is, I mean, as you can probably tell, like with some of my story here, and we'll get through all the content today, so don't anybody be worried, but you can see where there's really a lot at play here. And I think as I go into this next part here, this really the whole approach here with the hybrid is to talk about how the top down and the bottom up match. And again, this is a key area where we as accountants, I think, have a role in this. And we need to have a say in the organization. So I'm suspecting that of my fellow CPAs who are on the call here today, people who are trying to get your CPEs, I suspect some of you, and I know some of you are with firms and you've got clients and, and you're seeing some of these things. So I'm hoping that you can glean something out of here and try to sell that strategic side of your firm, right? So as accountants, we need to be able to say, not only do we have this historical approach, right? We're not just looking at what's in the past, but we can help take that information and help you make strategic decisions. You internal accountants out there, right, who are actually working in the clients, right? You're there with your company. Same thing, right? And it's difficult. I know, I've been there. It's difficult to oftentimes get a seat at the table with the executive team, with the business development team. But we got to show the value and say, hey guys, we're on the backside calculating profitability. We're looking at all these ROI and other KPIs, right? We're looking at stuff. We know why you guys are not hitting some of these targets that you want to hit, and we want to show you. So hopefully you get something here today and you have an opportunity to get in front of those people and say, and in fact, I think what you need to show them is this next part here. If you show them, I think nothing else about what we talk about today, show them this hybrid approach. So the question that we're asking here is, can I sell at a market rate? And I should say market rate, not marketing rate. Sorry about that. Can I sell at a market rate and make money? Right. So the pitfalls of a single approach, right? Again, before we looked at a single approach, if I look at the top down only, right? If I go out and say, what does the market bear? And I think that's one of the things that I forgot to say when we talked about that, right? Part of the top down approach is, what is the market willing to bear, right? For, if you sell something that is a commodity, it's difficult to alter that price, right? Because, look at gas. How many of us drive an extra block, maybe even an extra mile sometimes to get cheaper gas? We know, hey, if you go to and I can tell you out here in California what's nice is, if you go to the ARCO stations, if you're not in California, if you ever come to visit, find one of the ARCO stations. Cheaper gas. Part of the way that they offer cheaper gas is you can only pay with your debit card. It's a cheaper processing fee for them, so they offer cheaper gas. A little trick there for you. But I will go out of my way, right, to drive to the ARCO because I'm getting the exact same gasoline. I don't care whether, some people I know think, that one brand is better than the other. But at the end of the day, I'm putting gas in my car, and I don't care which station that it comes out of. And if I can drive an extra block or an extra mile, and when you're filling up, my car takes like 17 gallons. So if I've let it go down near to the bottom, right, if I can save, and sometimes on the difference of price, right, if I can save 20, 30, 40 cents on a gallon of gas times 16 gallons or so, right? If I run it near the bottom, that's a pretty significant savings for me, right? And I'm willing to do that. You know, some other stuff from a market price approach, again, like back to accounting services and some other stuff, there's typically a different range, right? And people are buying on value, they're buying on something else. But if I look at a top-down approach, my cost, this is one of the pitfalls of the top-down approach, my cost might exceed the market price, right? So if I just go out and say, hey, everybody else is selling this, let's even look at my accounting services. And I see this, and again, this is where also you have to go back to, you've got to understand those competitors. I know that I have some small individual contractor competitors out there who sell similar services. We can debate the quality of some of those, but they sell same or similar services at a lower price than us. And I know part of the reason they're able to do that is because they're a single person, right? They're operating out of their business, operating out of their home. We work from home, but we have a firm of employees. We have fringe expenses. We have a lot of marketing and advertising and other expenses that go into, us building our business and what we do. We have a lot of investment in technology and security and cybersecurity stuff, right? So those are the kinds of things that drive up my price. And I tell you that because if I go out and I say, well, there are people out here selling the same service for $150 an hour, and I'm selling it for $195, maybe I should only sell it for $150. But if I don't go back and regularly look at my cost and understand what it costs me, what if when I calculate my cost, I figure out maybe it costs me $140, maybe it costs me $160 to actually deliver that. Right, and if I'm selling it at 150, well, there's obviously a problem in there, right? I can't sell it at 150 for very long because I'm going to be out of money, right? I'm not going to have cash to pay bills. And so if I sell it at 195 as an example, and my costs were 160, then okay, then I've got at least some margin in there, right, to cover that. One of the pitfalls to the bottom-up approach, though, right? So here's where you got to look at it differently. I might be leaving money on the table. Right, so arguably, some of my small one-off competitors out there probably could charge, and I know some of them because there's one guy that I've talked to and I know what his rate is. He's a good friend of mine. He does some different work. Actually, I refer some work to him because he does something different than what we do. It's a complementary service, but I know what his rate is, and I'm like, man, you're leaving money on the table. But his approach is, right, he's retired. He's got a couple of things, right? He's retired. Kind of his second career doing this. He's got other sources of income, so it's not about that for him. But I'm like, you could charge, like I think he charges $125 an hour, and I'm like, I know your competitors are charging $175, and he's still making money at $125. Don't get me wrong, but if he went out and looked at the market, right, he could be charging $175 and making even more money. So you got to look at it from both perspectives. And we've got a polling question here, and I'm going to talk some more about this hybrid approach and why and how you look at it from both perspectives.
All right, so this is our fifth poll. The question is, which is a pitfall of a top-down only single approach? I did shorten the answers just a bit to fit within the GoToWebinar character limitations, but I think the right answer is still on the screen. We have about 50% of the audience has clicked in. That's increasing pretty quickly, so we'll leave the poll open for about 5 more seconds here. All right, so we'll go ahead and close that down. How did everyone do?
So it says, which is a pitfall of a top-down only approach? Right, A there is the correct answer. Your costs may not leave enough room for your desired profit or potentially even any profit, right? Then look back at the two examples that I gave earlier when we were talking, and the second one I should say that involved me was the cell phone industry, and the other one was retail, and they're both retail. The other was the ATVs and lawnmowers and motorcycles, right? But they were looking at what was the market price, what was somebody willing to pay, and not understanding what their full costs were, and actually, unfortunately, what ended up happening with both of those companies is that they went out of business. I stayed with my company for a little while and actually had an opportunity to move on to another job, but it eventually closed up because even when I had finally educated everybody and showed them what was involved and showed them where the real costs were and what the selling prices need to be, unfortunately, they had incurred several $100,000s of losses prior to that. And as a small business, they were just never able to dig themselves out of the hole, right? And that's one of the problems, right? That's, again, and I don't know the exact number of details that happened to my mom's employer, but I can imagine, right, that they hit a point where, you've maxed out credit cards, you've maxed out line of credit and other stuff, and eventually, right, there's no more cash, and we just can't continue on. Some alternate pricing strategies, right? So what are some other things I can do? And one of the questions here, I should say the question that we're trying to answer is, how can I improve my profit margin? And I think most of you know the answer to this. There's only two things I can do, right, to improve my profit margin. One is to increase price, and the other is to lower cost. No magic here, right? If I want to make more money in selling my product or service, I've either got to raise the price or lower the cost. Maybe I can do both. That's an awesome approach, right? If I can figure out how to increase the price and lower my costs. When we talk about lowering costs, that breaks down into reducing my direct costs, right? So in the case of that's reducing my labor, material, travel, ODCs, subcontractors. So figuring out either paying my employees less, not giving them as many raises, trying to figure out how to buy, the material cheaper, buy larger quantities, whatever the case may be. And then reducing my indirect costs. Now, within indirect costs, there are a couple of approaches, right? So one is I could reduce the pool itself, right? So I could lower my fringe, my overhead, and my G&A expenses, right? So that would make for each of those rates, right? I got my pool or my numerator, I've got my base or my denominator. And so if I can make the pool smaller, the numerator smaller, right, what happens? My rate goes down, right? So if I can reduce those pools, what's the other way that I can reduce my indirect rates, right? Is to increase my direct costs as a whole, right? Because direct costs are at least a portion, and really a significant portion, of the base of each fringe, overhead, and G&A. So if I can increase direct costs, right, then what happens? Then I've increased that denominator, and my rates are going to go down. We look at product and service mixes. My pricing, which includes profit or fee, can be adjusted on individual items in a complex proposal where the reduced profitability on one item is outweighed by volume profit on another. This is helpful where you're selling a set of complementary products or services. Could be things like add-ons or situations where multiple items are required for a complete solution. Go back to my printer example, right? So I said that, if you look at the major companies out there, and if we could, right, if we could get into those financial details, we'd find that they're not making money on those. In fact, I wouldn't be surprised if on many of those models, they're losing money. Right? We used to say we're wrapping $100 bills. We had a product for one of my previous employers. We used to not so jokingly comment that every month we were wrapping $100 bills around every unit because we were losing money on that particular product. In the case of printers, right, again, where are they making their money? So even if they're breaking even or losing money on something, they're making their money on the ink and the toner that you're going to buy later. And so they know that, right? And there is a strategy around that. Be careful here. Okay, so I will tell you what we've seen happen. We've seen situations where a client sells services. It's a contract for services, and that contract is made up of multiple labor categories. And so based upon the statement of work and experience with their client, with their ultimate customer, there was a certain understanding or expectation that, as an example, and I'll simplify this. Let's say there's 4 labor categories. there was a certain expectation that you were going to spend 20% of your dollars on labor category 1 and 40% of your dollars on labor category 2, and make sure I'm counting up correctly, right? So that's 60, 30% on labor category 3 and 10% on labor category 4. And so as you're looking at, and here we got to be looking at what's the price of the individual labor categories, right? But what's the total price of the contract as well, right? So that's part of what my customer is always looking at. They're looking at what is it going to cost me for the total solution, but as part of my evaluation of your price, right, I'm looking at what are the individual prices, not individual costs, separate conversation, but I'm looking at the individual prices for those labor categories. So we had a situation where the client said, hey, on this, one of the ways I can make this work, because I kind of know what the budget is that the client, that their client is trying to work towards. I kind of know what their limit is, and one of the ways I can get there is I can reduce my price on labor category 4 that's only 10% of the overall projected number of hours. I can reduce my price on that down to just above cost. I mean, I don't know, they took it down to like 2% or 3% or something. So the idea was they were essentially breaking even on that, but they were making, fair profit on the others. So they won the award, they did the work, and what happened? Unfortunately, and the client didn't necessarily know. Their client didn't know, hey, that they're breaking even on this category, but they're not on, they're making money on it. The client didn't know that. They just looked at total, looked at the total price was in the budget. They did a price reasonableness assessment on each of the individual labor categories, said, yes, it's all good. The problem was that throughout the year of delivering the services, their client was using more of labor category 4, right? And I forget the exact numbers of how it came out, but it turned out that they ended up using about 30% of the contract dollars on labor category 4, and some of the others up above then obviously came down significantly. So what happened was, there was a significant portion of that contract where they were barely breaking even. And so now their overall profitability on that contract took a significant hit because of that. This is where I would tell you to be very careful if you're going to take an approach where you adjust pricing on individual items, adjusting that profit or fee on individual items. Another example here, what you might consider is you might reduce the price of a core item, again, knowing that you'll make the money on the installation, training, or annual support contract. We see this in the software field, right? So if you're buying software, you pay for licensing up front. Sometimes you can negotiate, and oftentimes you can negotiate a reduced price on licensing, but the seller knows that they're going to make a certain amount of money in the long run because you're going to come back and continue to buy the annual support contract, right? So another way to balance that out. Another polling question here, Liz, I think this is number 6, if I'm keeping track.
It is, yeah, yep. What is a good way to improve profit margin? I like these polling questions. They're really good recaps. Looks like we're doing well here, Robert. Responses are coming in quickly, and they're coming in for what looks to be the right answer. So that's good news.
I'm doing a good job, and they're paying attention. We'll give each of us credit, I guess.
Paying attention. I think the illustrations really help a lot. All right, let's go ahead and close the poll down. And yes, the correct answer is A and B. Increasing price and lowering costs are both good ways to improve profit margin. So that's awesome. We'll go ahead and keep rolling.
That is correct. Yeah, we've got a little more content here, and then we've got some time for Q&A. If you haven't yet, drop those questions in the question panel, and we'll try to answer as many of them as we can before the end of today's session. All right, so looking at adjusting profit or fee, an overall increase in direct expenses should result in lower rates across the board, right? So this back to that concept, remember, where my indirect rates will come down if I can bring on, right, additional work, right? Because oftentimes we have the ability to absorb work, right? We have bandwidth, we have a certain amount of idle time where employees could be doing more billable work without an additional cost to me. In those cases, I might be able to get increased profitability, right? If I can still sell that at the market price, this is kind of an interesting concept to think about. If I can sell that product or service at the market price, and I can sell more of it, right, from a direct cost perspective, without increasing my indirect costs, right? And so what would happen is my indirect rates would come down. Then I've effectively increased my profit margin even more, right? Because if I can do something right and sell it at an overall lower cost, right, I'm making more money. And so this is one of the ways to do that. Negotiating prices. Be very careful negotiating on profit or fee alone, especially in the government. I mean, I'm sure this happens in the, well, and I don't know. It probably happens somewhat in the commercial world. Unfortunately, we see this kind of stuff happen in government contracts where the government or the prime, and I have to say, when profit and fee are separately disclosed. On fixed price contracts, they're not supposed to be separately disclosed. They're supposed to be negotiating the top level price. But if you're on a cost type contract, for example, and you have to disclose your profit or fee amount, be careful, right, negotiating the fee or profit alone, right? If the customer wants to negotiate that, they should be talking about adjusting the scope, right, which can include the amount and the type of work, the schedule, warranty. You know, there's some different factors. Let me go back here. There's some different factors that we should be looking at, right? Because the problem is, if somebody comes in and let's say you bid, as an example, 15% profit, and the government or the prime says, well, we don't want to pay 15% profit. We only want to pay 8% profit, or some crazy number, right? And you end up negotiating, well, you're still doing the same amount of work with the same amount of risk, and now you're taking away what could have been or probably was a more appropriate amount of fee or profit associated with that risk, right? So if you're going to reduce the reward, right, then we need to reduce the risk in some fashion, right? There's always this risk-reward scenario that comes into play here. So the way I reduce the risk is we talk about the amount and the type of work, the schedule, and the warranty among some potential other items. As you can see, the strategic pricing here, there's a lot at play. We have to do all of the homework, right? We have to look at the top down. We have to look at the bottom up, right? We need to figure out what that initial gap is, right? Can I sell this, right? Remember the question on the hybrid approach was, can I sell this at a market rate and make my desired amount of profit, right? But I can only know that by calculating the bottom up cost. Then I have to figure out, okay, what are my options, right? If I don't like what that looks like, then as a business owner, as a manager, I have to figure out either how to increase the price or how to decrease my cost, right? And what are some ways that I can do that? We've got, I think, our final polling question here, Liz, and then we'll jump into that Q&A.
All right, that sounds great. Well, given what we've covered today, what's your comfort level on pricing for profitability? So we would love to hear from you and just find out if you feel like you've got it now. Maybe you're a little fuzzy, but you can manage. Perhaps maybe there's still a few things you'd like to have cleared up, or if you need help with your pricing strategy, then I think you definitely heard from an expert today who would be happy to help. So looks like the responses are coming in. So thank you everyone for responding. We have a comment from Robert that says, great webinar. And we're going to go ahead and segue into Q&A here as we get ready to close the poll down. We have Jenny from Robert's team on the line. Jenny always does so much work behind the scenes to help us get these webinars put together and put on. So Jenny, are there some questions that you're seeing that we can start taking?
We do have a question in the queue, As the principal of an accounting, consulting, and audit firm, what is the best way, in your opinion, for an owner to differentiate his or her services to attract more business and be the most successful?
Sorry, I was on mute there. That's a great question. As an accounting firm owner, I will tell you one of the things that I'm seeing in the accounting space, so I said that we still do really T&M work. We have shifted to do more fixed price work, and I'll tell you how we're doing that. We're taking this best value approach, and I wish I could say that I was the one smart enough to come up with it. I wasn't, but I was smart enough to pay attention and figure out how to bring it into our firm and adapt it. And so for accounting, and there are a couple of things at play here, and part of this really is a shift. There's got to be a shift within your firm and how you think and operate. There's got to be a shift in your marketing strategy. And that shift is around, we need to be, as accountants, we need to be strategic partners for our clients. And if you're an accountant in a client, right, you're working in a company, then we need to be a strategic partner within the company, right? Again, accountants, we get the bad rap for looking in history. How many times we probably all heard that, right? We're the people looking in the rearview mirror because we're the ones capturing the historical information. We're recording those transactions. We're calculating what happened last week, last month, last year. Doesn't mean we're bad people. That's good information, right? We need to know those things. We need to know, did we make money last month? And how much money did we make? But what we really need to know, and this is where, again, the strategy comes in, and being a good partner is, we need to help interpret those results and show people that we can take that to the next level from a decision-making standpoint, right? And so we can't just go to our clients or go to our internal management team and say, okay, here's last month's report. You guys made whatever, or you lost whatever. Okay, here's your report. No, we need to help them understand that. Like, why did they lose money? Why did they not make as much money as they thought, right? So it may not be that we've lost money, but if you're bidding 15%, so it's, we just recently did this with one of our clients on a project, is we helped them calculate their profitability across projects and across contract types within those projects, because we knew generally what they were bidding. And so what was interesting to see was, hey, we're typically bidding 15% on this type of contract and this type of work, but what we're seeing is that we're really only netting about 12 to 13%. Why is that? Right? So now we can dig in and help them from a variance and analysis perspective. Bit of a long-winded answer, but we got to show that. And so what we've done, and here's where the rubber meets the road, and what we've done with our firm. And again, we're seeing this with other firms out there. What we are selling in a fixed price approach is this analysis. So we're working with our clients to say, for a set amount of money, and it varies a little bit by client, we make some customizations. For a set amount of money per month, we have calculated an internal blended rate across different people who could potentially help them. We sell them a flat number of hours where they get this kind of support. And the idea is twofold, that it doesn't really matter who ends up doing the work. They have access to all of us based on this blended rate. They have access to all of us. And while we track the hours, we don't get into, oh, wait a minute, you used an hour more this month, let me send you an invoice for that. We don't want that. We want to eliminate this fear and this theory of, okay, if I call Robert, he's going to turn on the clock, and at the end of the month, I'm going to get an invoice for 1.25 hours because I got on the phone with him. We don't want that, right? We know that's one of the barriers, especially for a lot of small businesses, right? If they're money conscious, they're worried about every time they call the attorney or they call the accountant because they know the clock starts ticking. We got to get rid of this time clock approach and say, we're here to provide you value. So for X dollars a month, we will provide this scope of services. And now what we know is that within a client from month to month, it'll vary, right? They might use more one month, less 1 month as an example. So even within a client, we're looking across time and saying that within a year, right, it should be about this throughout the year, right? And so we kind of average that out. And then the other thing that you're looking at is across clients, right? Kind of the similar approach is, while one client might use more this month, I know I've got other clients who probably won't, right? And so even within a month, from a time and a dollar perspective, I know that it kind of balances out as well. Hopefully, again, a bit of a long-winded answer. I hope that's helpful and makes sense to you in the accounting world.
Question for you, Robert. So you mentioned 15%, and it sparked a question with government contracts. How common is it that there's a lot of extra visibility where when you're submitting the contract, I think we've talked about cost plus contracts before, where there's a lot more disclosure in what the markup is or what the company's margin is? Is there kind of a, I suppose I'll stop there. How is there more transparency with government contracts than a private company might find?
The answer to that is yes, and it's further, it's complicated and cloudy on the government side because, again, in a cost type contract, you have to submit details of your cost estimate. So you're going to submit how much labor, how much material, how much overhead, all those direct cost elements. You've got to show what your rates are, right? You've got to show this is our fringe, this is our overhead, this is our G&A, and here's the profit and fee that we are proposing.
Right.
And I won't go into a lot of details that, on the cost type contracts, there are some limitations about what the cost or fee can be. But if you get into award fee and incentive fee contracts, there's some other factors that come into play. In that situation, right, we do have to disclose all of that. And again, we typically don't see that approach in the commercial space. Now, unfortunately, and this is where it gets a little cloudy and confusing, is you have a lot of government contracting officers, you have a lot of primes who, because they're used to seeing cost on a lot of contracts, that when they, and there's cost details, actually getting in and seeing that stuff, that when they get to a fixed price contract or a T&M contract, they start asking for it, and they're not supposed to.
Okay.
You got to push back. Yeah, you got to push back on that stuff. We see situations where, again, in a fixed price contract, right, it's risk. Well, all of this is risk and reward, right? It's balancing risk and reward.
Right.
And on cost type contracts, the risk is lower, right, because you're getting cost reimbursed, by the government. So the government says we're bearing a lot of the risk, so the reward is going to be smaller, right? We're not going to pay as high of a fee. The opposite end of the spectrum with a fixed price contract, right? You, the contractor, are taking that risk, and so then now the reward or the profit and fee needs to be higher.
Right.
Unfortunately, what we see is that, again, contracting officers or primes will ask for that when they shouldn't. And unfortunately, you end up in situations where companies either don't know that they shouldn't provide it, they're afraid to push back, they don't know how to push back. And so they end up sharing that information. And we see I've seen too many situations where, and I pulled 15% out of thin air. I will say that on a lot of T&M fixed price contracts, without a doubt, you should be able to bid 15, 20% as a profit or fee, potentially more, but 15 to 20% on T&M and fixed price contracts is fairly normal. But unfortunately, we've seen a number of clients who have signed up for a fixed price contract where they are bearing responsibility and they've accepted a profit or fee sometimes as low as 6%.
Oh, wow.
And then right. And so what happens, right, is what happens when you have a little bit of overtime, right? Or you run into some kind of hiccup, and it's not necessarily that the contractor did something wrong or bad, right? But things happen, right? We run into situations where we got to incur overtime in order to meet the deadline. And in the case of a fixed price contract, who's eating at that overtime? Me, the business owner. And if I accept a contract with only 6% profit, then I'm eating into that profit.
Absolutely. That makes a lot of sense. We're going back to the risk reward concept. Well, there's
Yep.
a lot there, and thank you for addressing that. Well, it looks like we're getting right up to the top of our time together, the end of our time together, but I think this segues well into the topic for November. If you have a slide that gives us, I believe that date is November 10th, which is a Tuesday, 1 p.m., same time. And we're going to talk about job costing. Anything particular that you want to point out to set the stage for next month?
I guess that what I would just say is, if for those of you who've been with us, we talked about job costing as part of the SF-1408 survey, right? And this is where we're going to really get down and look at how we capture direct costs to each job and how we assign indirect costs to each job. And what I just said a few moments ago, where I said we help the client do a deeper evaluation on a job by job, but as well as on a job type or a contract type approach. We had the data, they had the data, we helped them compile it and analyze it and figure out, hey, we've got some issues here on these types of things. We need to look at how you're pricing these particular types of jobs.
Excellent. So we hope that you'll join us. As we mentioned at the beginning, we do have 3 self-study courses by Robert. Laying the foundation for government contract accounting, fundamentals of indirect rates, and advanced indirect rates. So those were the first 3 programs in the series this year. So if you're interested in going back, you can download the handouts, click through the links, and access those courses, which really provide just a great backdrop for a lot of the topics that we covered today. So Robert, we're looking forward to having you back with us next month. Thanks for a fantastic presentation, and we hope everyone has a wonderful rest of the day. And Robert, I know that you're traveling for a conference, so I hope the rest of that conference goes well for you, and we'll talk to you soon.
All right. Thank you. Everybody have a good day.